Welcome to FinTech Guru. Here we are analyzing Indian stock market from its official sources. All materials are strictly for study and research purpose only. For investments, you have to consult with your SEBI-approved persons or do on your own. Again, welcome to SIVA Presents FinTech Guru. All right, today we're taking a close look, a real deep dive into Vedant Fashions Ltd. You probably know them best through their main brand, MANYAVAR. The tickers are NSEI. MANYAVAR and BSE 543463.
That's right. And we've got a good stack of material to work from the latest annual report for 2024-25, investor con call notes, analyst reports too.
Exactly. So our goal here is to really get under the skin of the company, go beyond just recognizing the name MANYAVAR and understand, the financials, their strategy for growth, and also what risks might be lurking there. It's quite a unique player in the Indian apparel space.
It really is.
So first things first, what exactly is VFL's core business? What are they selling?
Okay, so fundamentally, they design and sell Indian wedding and celebration wear. Think sherwanis, lehengas, kurtas, the whole range. For men, women, and kids too.
But they see themselves as more than just clothing makers, right? I saw something in the annual report about innovation.
Yes, that's a key part of their positioning. They argue they've actually driven a shift, taking traditional Indian wear from something you only pull out for a wedding, maybe a big festival.
Right, special occasions only.
And making it more of a versatile, modern wardrobe essential. That's their phrase. It's about broadening the use case.
That's a big claim, trying to make occasion wear more every day. Well, maybe not every day, but more frequent.
It is ambitious.
Yeah.
And it's probably the best way to understand why they have this portfolio of different brands. It's not just one size fits all, it's segmented.
Okay, let's unpack that brand structure then, because that seems central. Most people, like I said, know MANYAVAR.
Absolutely. MANYAVAR is the flagship. It's the leader, really, in branded men's Indian wedding and celebration wear. Sits comfortably in that mid-premium price bracket.
And they have that really distinct policy about sales.
Ah, yes, that's crucial. The no end-of-season sales or discounts rule. They stick to it rigidly.
Which is pretty rare in retail, especially fashion.
It is. But think about it. For weddings, which are high emotion, high value purchases, constantly discounting can actually erode brand perception. By holding the price, they signal quality, exclusivity. It's a core part of their brand management.
Yeah, makes sense. Protects the margins too, I imagine. We'll get to financials later, but that must help.
Definitely. But a wedding isn't just about the groom, right? So they needed something for women.
That's where Mohey comes in.
Exactly. Mohey targets the women's side, also in that mid-premium segment. But it's interesting, they recently shifted its focus.
How so?
It used to be seen mainly as, for the bride, bridal wear. Now they've repositioned it as a complete wedding wear destination.
So not just the bride, but bridesmaids, family, guests?
Precisely. Broadening the target audience significantly. They back this up with a big marketing campaign, too, featuring Janvi Kapoor. The whole job app Tayar, Hum Tayar thing. It was about making Mohey relevant for more people at the wedding.
Okay, so MANYAVAR for men, Mohey for women, both mid-premium. What if someone's looking for something a bit more upscale?
That niche is filled by Twamev. Twamev. This one is deliberately positioned as bridge to luxury.
So a step up from MANYAVAR and Mohey.
Yes. Targeting the key wedding markets, offering more exclusive designs, maybe more intricate work. It's for that customer wanting something a bit more special, willing to spend a bit more.
Got it. And then there's the push to normalize Indian wear beyond just weddings. You mentioned that earlier. Is there a brand specifically for that?
There is now. That's Diwas, D-I-W-A-S. This is quite new, and it's their first direct-to-consumer, or D2C, brand.
D2C, interesting. So selling directly online.
Primarily, yes. And Diwas is focused squarely on the festive and broader celebration wear segment. Think Diwali, Eid, Rakhi. India has, 50-plus major festivals?
Loads.
So the idea with Diwas is to tap into that market, make Indian wear a natural choice for those occasions too, not just the absolute biggest life events like weddings. It ties right back into that modern wardrobe essential ambition.
Right, makes sense. Are there any others we should know?
Just quickly, they also have Mebaz, M-E-B-A-Z. That was an acquisition from some years back, and it's still part of their overall offering.
Yeah.
So quite a comprehensive portfolio covering different needs and price points.
Okay, that gives us a really clear picture of what they sell and who they're targeting. Now let's get into the mechanics, the how. What's the actual business model? Where does the money come from, and where are they spending big?
Right. So the first thing to grasp is that VFL runs a pretty asset-light operation, especially on the retail side. The vast majority of their revenue comes through their exclusive brand outlets EBOs.
Okay, the standalone stores like the Manyavar shops you see everywhere.
Exactly. And the operational structure behind these is overwhelmingly a franchise-based model. You'll find that detailed in the financial statement footnotes, specifically note 25.1 if you want to dig in.
Franchisees. That explains how they've scaled so quickly, right?
Oh,
Less capital needed from VFL itself for each store.
precisely. It allows for rapid expansion. As of March 2025, they had a huge retail footprint, 1.79 million square feet across 678 stores. And these are global, not just India.
Wow, 678 stores.
Yep. And the franchise model means VFL doesn't carry all the direct costs and risks of running every single one. The franchise takes on a lot of the local operational load. VFL focuses more on the brand, the product, the supply chain, and crucially, the technology that holds it all together.
Technology. You mentioned they spend big here. Where exactly is that investment going?
It's pretty strategic because when you have a decentralized network of nearly 700 stores, mostly run by partners, technology becomes your central nervous system. It's how you maintain control, efficiency, and a consistent customer experience.
So not just basic sales software.
Oh no, much more sophisticated. We can see three key areas from the con calls and reports. First, inventory management. This is critical in fashion to avoid getting stuck with unsold stock.
Especially with seasonal stuff like wedding wear.
Exactly. They use an algorithm-based system. It monitors stock levels across all stores in real time and apparently optimizes replenishment automatically based on demand, seasonality, location. The works. Cuts down on guesswork, gets the right product to the right place.
That sounds essential for efficiency. What's the second area?
This one I find particularly interesting. It's about empowering the frontline staff. They launched something called the VFL Paravar app.
VFL Paravar. Family?
Kind of, yeah. Paravar means family. It's an AI-driven learning platform rolled out to over 3,000 of their fashion advisors, the people actually interacting with customers in the stores.
An app for training staff. How does that work?
It delivers continuous bite-sized training, think like 2 or 3 minutes a day, directly on their phones or devices.
What kind of training? Product details.
That, definitely. Deep product knowledge, fabrics, embroidery types, sourcing stories, but also things like understanding regional wedding customs, which vary hugely across India. And crucially, sales techniques, how to advise customers effectively, how to perhaps upsell or cross-sell between Manyavar and Mohey, for instance.
So turning store staff into expert consultants almost.
That seems to be the goal. In a high-touch sale like wedding wear, having knowledgeable, confident advisors is a huge plus. Standardizing that level of expertise across 3,000 people in 678 stores. That's potentially a major competitive advantage if they get it right. It's sustained, tech-enabled human capital development.
Very interesting. And the third tech pillar?
That's focused on the customer experience and leveraging data. They're investing in advanced customer relationship management, CRM, and marketing technology, MarTech stacks.
Okay, so using tech for marketing and customer engagement.
Right, things like AI-powered conversational commerce, maybe chatbots handling initial queries online. Also, augmented reality, AR styling tools. Imagine virtually trying on different outfits.
Wow, okay.
And behind the scenes, using all the data they collect to personalize marketing, improve customer retention, target offers more effectively. It's about making the whole customer journey smarter and more engaging.
So a very tech-driven approach behind the physical stores. Now, what of the actual clothes? Where are they made? Given the asset-light retail model, do they own factories?
Mostly no. Sticking with the asset-light theme, their core manufacturing is largely outsourced.
So they don't make most of the garments themselves?
Correct. It's common in fashion, avoids the huge fixed costs and risks of running massive factories that might be underutilized off-season. They maintain flexibility this way.
But they must do some production in-house for quality control.
Yes, they keep the critical value-add stages in-house. Things like cutting the fabric, specialized stitching, and the final finishing touches. These happen at their own factory units. They also handle storage and dispatch from their own warehouse facilities.
Where are these facilities located?
The main ones mentioned are in West Bengal, specifically Howrah and Basat. And across this whole outsourced supply chain, the company emphasizes, particularly in their sustainability reporting, a commitment to transparency and ethical, sustainable sourcing.
That largely outsourced part always raises questions about supply chain visibility and ethics, though. We should probably touch on that again in the risks section.
Absolutely. It's a key area to watch in any apparel company using this model.
What about international trade, exports, imports? You mentioned global stores.
Their export volume is actually quite small right now. In the last fiscal year, FY 24-25, exports only made up 2.62% of total turnover.
Oh, okay. Not a huge part of the business then.
Not in terms of direct exports, no.
Yeah.
But they do have those international stores, so there's international exposure. And even with that small export percentage, they actively manage foreign exchange risk. The financial statements mention they use forward contracts to hedge against currency fluctuations. Shows good financial discipline.
Okay, that paints a solid picture of how they operate. Asset light, tech heavy, franchised retail, outsourced production with key controls in-house. Now let's connect this to the numbers. How did this all translate financially in FY 2024-25? This is section 3, financial performance, and looking at the figures, it seems a bit mixed.
Mixed is a fair way to put it, yes. Needs some interpretation. Let's start with the top line, the turnover. It did increase, but only marginally. Went up to about INR 13,865 million from INR 13,675 million the year before. So slight growth, but pretty flat overall.
Okay, so revenue didn't jump dramatically. What about profit?
That's where we see the declines. Profit before tax, PBT, fell. It went from around INR 5,484 million down to INR 5,195 million.
And after tax?
Same story. Had also dropped from roughly INR 4,142 million to INR 3,885 million.
So lower profits despite slightly higher revenue. That means margins took a hit.
They did. The profit after tax margin, the PAT margin, slipped from 30.3% down to 28.02%. That's a noticeable compression over 2 percentage points.
And that flows through to earnings per share, I assume.
Naturally. Basic EPS declined from INR 17.06 to INR 15.99.
Declining profits, shrinking margins, lower EPS. On the surface, that doesn't sound great, even with the revenue holding steady. Is this a red flag? Is the business struggling?
Well, this is where context is crucial. Management's commentary, especially in the investor calls, paints a different picture. They highlight one metric that held absolutely firm, the gross margin.
Gross margin, so revenue minus the direct cost of goods sold.
Exactly. And that gross margin stayed stable at 67.2%, identical for both FY24 and FY25.
67.2%, that's quite high, isn't it?
It's very strong for apparel, and the stability is what management points to as a significant achievement.
Why is keeping that gross margin stable so important, especially when the net margin, PAT margin, is falling?
Because it tells you something fundamental about their core operation and pricing power. Remember the newer brands we talked about, Mohey, Twamev, Diwas?
Yeah, the ones that are pushing for growth.
Right. These brands are growing faster than the mature MANYAVAR brand. But launching and scaling new brands costs money, more marketing spend, maybe slightly different sourcing costs initially, higher operational efforts during ramp-up. So the operating expenses are likely increasing significantly.
So the costs below the gross profit line are going up. Marketing, admin, and tech investment costs.
That seems to be the implication. The overall revenue mix is also shifting towards these newer brands. While they have high potential, their initial net contribution might be lower than the super efficient MANYAVAR segment. So VFL is essentially accepting lower net profitability now.
To invest in building these future growth engines. Mohey, Twamev, Diwas.
Precisely. They're spending more on operating costs, marketing, tech, expansion, to fuel that diversification. The fact that the gross margin stayed put at 67.2% suggests the core profitability of their products. The difference between selling price and the direct cost of making them remains incredibly strong. It signals the PAT drop is likely driven by strategic investment and maybe some external pressures, not a fundamental weakness in their product economics or brand pricing power.
Okay, that's a really important distinction. It sounds like a deliberate trade-off, sacrificing some short-term net margin for longer-term strategic positioning and growth.
That's certainly the narrative management is conveying.
Did we see any other efficiency gains, maybe in managing money owed or owing?
Yes, a positive sign on the working capital side. Their accounts payable days, basically how long they take to pay suppliers, improved. It went down from 78 days to 72 days. That suggests better cash flow management.
Any changes on the dividend front?
A slight tweak downwards. The board recommended a dividend of INR 8.00 per share for FY 24-25. That's down a little from INR 8.50 the previous year, consistent with maybe being a bit more conservative given the investments and the slight profit dip.
Okay, now let's zoom out. How does VFL fit into the bigger picture of the Indian market, especially the wedding sector? How big is this market they're playing in?
The scale is just immense. Estimates put the Indian wedding market at around USD 130 billion a year.
130 billion. Wow, how does that compare globally?
It's huge. China's is estimated around $170 billion, but the U.S. market is significantly smaller, maybe $70 billion. So India's right up there. a global powerhouse for wedding spending.
And it's not just the overall size, is it? There's something about the cultural importance.
Exactly. There's a fascinating metric highlighted in the sources. Wedding expenses in India relative to the country's GDP per capita.
Okay.
That ratio is 5.1 times.
5.1 times GDP per capita spent on weddings.
Yep. Compare that to the US, where it's only 0.4x, or Spain at 0.7x. This tells you just how incredibly important weddings are culturally in India and how much families prioritize spending on them, often disproportionately to average income levels.
So the spending is almost inelastic. People will spend on weddings regardless of the broader economy.
To a large extent, yes, it's deeply embedded culturally. This provides a huge underlying resilience for VFL's core market. Even if general consumer sentiment dips, wedding spending tends to hold up much better than other discretionary categories. It's a structural advantage for them.
That cultural factor plus the strong gross margins. I guess that explains why credit rating agencies still seem positive.
It certainly helps. Their long-term credit rating was recently reaffirmed, possibly upgraded, to CRISIL A stable as of July 2024. That's a very solid rating.
Are they borrowing a lot to fund all this expansion in tech?
Actually, no. The report specifically mentioned their cash credit facility, basically. A line of credit from banks is unsecured and, importantly, unused.
Unused. So they're funding everything from their own profits.
It seems so. They're relying on internal accruals, operational efficiency, and that asset-light model rather than taking on significant debt. That financial conservatism is generally viewed very positively by investors.
Okay, solid financial health despite the recent profit dip, operating in a massive, resilient market. Let's look forward now. Section 4, future perspective and growth strategy. What are the expectations? What's the plan to get those profits growing again?
Well, analysts seem reasonably optimistic, assuming VFL executes well. The Simply Walsane data we looked at from around October 2025 forecasts earnings to grow at about 11.1% per year.
Okay, double-digit earnings growth forecasts. And revenue?
Revenue growth is projected around 9.9% per year. And they also forecast return on equity reaching a healthy 22.00% within 3 years. So the expectation is return to solid growth.
How does management plan to achieve that, especially getting growth from existing stores, not just opening new ones?
That's the key focus. Same store growth, or SSG. As the network matures, you can't just rely on adding more and more stores. You need to make each existing store more productive. Management has been quite specific about the levers they intend to pull here, especially in the con calls.
What's lever number 1?
First is driving up the average selling price, ASP, within the current product categories. They're aiming for an organic ASP increase of 3% to 4% per year.
Just by tweaking prices or selling slightly higher value items within Manyavar and Mohey.
Exactly. Through strategic pricing adjustments and encouraging sales of slightly better items within those core brands, achieving 3–4% consistent ASP growth takes real pricing power.
Okay, that's the first part of ASP growth. What else contributes?
The second lever is the mix change. We talked about how Mohey and Twamev are growing faster.
Right, the women's wear and bridge to luxury brands.
Well, these brands generally have higher price points than the average Manyavar item. So as they become a bigger slice of the overall sales pie, they naturally pull the company-wide average selling price upwards.
Ah, okay. So even if prices within each brand only go up 3–4%, the overall average goes up more because the mix is shifting towards more expensive brands.
Correct. Management estimates this mix shift will add another 70 to 90 basis points, let's say 0.7% to 0.9%, to the ASP growth on top of the organic 3–4%.
So if you add those together, what's the total ASP growth target they're aiming for?
They're looking at a combined ASP growth target of roughly 3.6% to 3.7% annually. That's quite ambitious and signals a clear strategy to increase value extracted per customer, not just volume.
And beyond getting customers to spend more per item, are they trying to get them to buy more items per visit?
Yes, that's the third lever, increasing the average basket size, encouraging customers to buy accessories, maybe outfits for other family members, coordinating pieces, moving beyond just the single main outfit purchase.
Makes sense. More items per transaction.
Definitely. And underpinning all of this is customer retention. How do you keep customers coming back or buying across brands?
This must tie back to that tech investment, the CRM and MarTech stacks.
Absolutely. They mentioned having data on something like 80 to 90 lakh customers. That's 8 to 9 million people.
That's a huge database.
It is. And the plan is to leverage that data intensely for targeted marketing, personalized offers, reminding people about upcoming festivals or occasions. Basically, using data to drive repeat business and encourage customers who bought Manyavar to consider Mohey or vice versa.
So, data-driven retention and cross-selling. What about the physical stores themselves? Are they still just opening new ones everywhere, or is the strategy changing?
The strategy seems to be evolving. It's less about just adding raw numbers and more about quality of the retail space.
Mm-hmm.
They did add 85,000 square feet net in FY25, but they also talked about consolidating older, perhaps underperforming stores,
Consolidating, closing some down.
or relocating them, perhaps combining smaller ones. They specifically mentioned consolidation activity in places like Rajuri Garden and Delhi during the con call. The focus seems to be shifting towards larger, more experiential flagship stores.
Flagships, why the emphasis there?
Because for high-value, considered purchases like wedding wear, the store experience matters. A flagship can offer a wider range, better ambiance, more personalized service. It reinforces the premium positioning, especially for brands like Twamev and Mohey. So quality over just quantity now.
Okay. And any updates on the brand strategies, like Mohey's repositioning?
That remains key. Successfully establishing Mohey as the go-to for the entire female side of the wedding party, not just the bride, is crucial for capturing more market share. And continuing to build Daiwas for the festival segment helps them expand their addressable market beyond weddings altogether. The digital tools, like AR styling and the AI commerce, are meant to weave all these together for the customer.
It sounds like a very interconnected strategy, brands, tech, stores, data, all working together, but strategies always come with risks. Let's move to Section V, key risks and caution areas. What should potential investors be aware of?
First, the standard disclaimer you'll find in any annual report. All those forecasts and future plans are based on assumptions. They carry inherent risks, and things might not pan out as expected. Especially in fashion and retail, consumer tastes can change fast.
Right, the usual caveat. What are the more specific concerns right now?
A major one, acknowledged directly by management in the con call, is the broader economic environment. They stated that consumer sentiments remain subdued, particularly in the mid-premium discretionary spending category where they operate.
So people are still being cautious with their spending even if weddings are important.
It seems so. This acts as a headwind, making it harder to achieve those high-growth targets. Management basically said this external factor is currently holding back even better performance. It adds context to that slight profit dip we discussed. It wasn't just internal investment, there's real macro pressure too.
Okay, so the economy is a key risk factor to watch. What about specific financial or legal risks mentioned?
There's a notable one, a pending tax contingent liability. It relates to disputes with the Income Tax Department for assessment years, quite a while back, 2013-14 through 2015-16.
How much are we talking about?
The total potential liability disclosed is INR 183.04 million. That's about 18.3 crores.
That's not insignificant. Is the company likely to have to pay this?
Well, according to the financial statement note 43, the company is confident in its position. They state they have a supporting legal opinion, so they clearly believe they have a strong case.
But it's not resolved yet.
No, the final order is still awaited. So while they're confident, it remains a contingent risk. If the final decision went against them, that amount could become payable. It's something shareholders need to keep an eye on until it's fully settled.
Understood. Let's wrap up the risks by looking at ESG, environmental, social, and governance factors. These often highlight operational or reputational risks. What stands out here?
The ESG reporting actually has some interesting points, both positive and potentially risky. On the positive side, environmentally, VFL claims they achieved net positive climate impact for their direct operations, Scope 1 and 2, in FY 24-25.
Net positive. How do they manage that?
Primarily through carbon offsets, they purchased 850 tons of carbon credits, which exceeded their reported Scope 1 and 2 emissions from the previous year, which were about 822 tons.
So offsetting more than they directly emit.
Correct. It shows a commitment to climate action, even if it's via offsets rather than purely internal reductions. They also mentioned recycling 55 metric tons of plastic waste under their EPR, Extended Producer Responsibility obligations.
Okay. What about the S in ESG social, especially considering that outsourced manufacturing model we discussed?
That's where a key risk is explicitly acknowledged in their own Business Responsibility and Sustainability Report, BRSR. They recognize the risk of human rights abuses, specifically mentioning forced labor and child labor within their value chain.
And the potential damage to their brand if something like that were discovered.
It's exactly. Massive reputational risk for a premium celebration wear brand. Their mitigation strategy involves internal assessments, setting policy guidelines for their suppliers, and requiring adherence to laws.
Is that enough, though? Ensuring compliance down a complex, outsourced chain is notoriously difficult in the garment industry.
It's a constant challenge. Relying on third-party audits and self-reporting always has limitations. But the fact that they openly identify this risk and outline their mitigation framework is important. It shows awareness. They also noted progress internally, like achieving 100% health insurance coverage for their permanent workforce.
And governance, the G. How does the company structure look?
It seems robust and compliant. The board has 6 directors, 3 of whom are independent, which provides a good balance. They mention having strong governance processes like board evaluations, a whistleblower policy, etc. Good governance generally boosts investor confidence.
Okay, this has been incredibly detailed. Let's try to synthesize everything. We have Vedant Fashions, a major player in the huge, culturally significant Indian wedding and celebration market.
A market with that amazing 5.1x spending ratio relative to GDP per capita, giving it inherent resilience.
Right. Financially, they faced a bit of a slowdown in net profit growth recently, but crucially maintained very strong gross margins around 67.2%.
Suggesting the dip was more about strategic investments in newer brands like Mohey, Twamev, and Diwas, plus technology and perhaps some macro pressure, rather than a core business decline.
Their growth strategy now seems focused on same-store growth, getting more value from existing stores.
Yep, aiming for that 3.6% to 3.7% ASP growth through pricing and mix shift alongside boosting basket sizes and using their massive customer database for retention.
They operate asset-light with franchisees and outsourced production, have a strong credit rating, CRISIL A stable, and aren't heavily indebted.
And they're making significant bets on technology, particularly things like advanced inventory management and that VFL Paravar app for training thousands of staff.
Risks include the subdued consumer sentiment, that pending tax liability of around INR 183 million, and the ever-present ethical risks in the outsourced supply chain.
Exactly. It's a complex picture, but the underlying strengths, brand dominance, high gross margins, resilient market seem substantial.
You know, before we finish, let me leave you with one thought to ponder. Think about that VFL Paravar app, the one doing daily AI-driven training for over 3,000 fashion advisors.
Yeah.
The Indian celebration wear market is intensely personal, cultural, high-touch. It's not just about clicking buy. How much of a sustainable competitive advantage can they build if that app genuinely elevates the expertise and consultative selling skills of their entire frontline workforce day after day? In a sector like this, could that tech-enabled human element actually become their strongest, most defensible moat against competitors who might just focus on price or pure online play? Something to think about.
That's a great point. The human touch, scale through technology, definitely food for thought. Thank you for that incredibly thorough analysis. And a big thank you to all the FinTech Guru YouTube channel viewers for tuning in. And with a final request for subscription and to enable the notification button so that we can produce more videos like this.